Welcome back. We are now at Unit 7. We will be discussing retirement fund benefits as part of Class 4, retirement benefits, Class 4 of Class of Business. If we look at just some background as far as retirement fund benefits is concerned, the Act specifies that trustees shall make arrangements for the payment of benefits as provided under the rules of the fund as they become due. The trustees will usually delegate the tasks of paying the benefits to a fund administrator, the written terms of whose appointment should show clearly what functions are to be exercised by it and should set out the limitations on its powers. Matters referring or requiring referral to the trustee should be specified as well as arrangements for periodic reports to be made to them on how arrangements for payments of benefits are conducted on their behalf, and the fund administrator report should also be reviewed at every trustee meeting. Right, retirement benefits. These include retirement pension and or lump sum payable to members. The benefits arising under a retirement fund will be set out in the rules. Benefits of retirement benefits may be payable on, firstly, normal retirement, early retirement, including ill health or at retrenchment, or at late retirement. Retirement benefits must be dealt with following the fund's rules and in compliance with the tax laws. A key concern for people retiring is whether the amount saved for retirement will be adequate to maintain their lifestyle. And there are two critical components that members should be aware of. The first is the income replacement ratio. A replacement ratio is a person's gross income after retirement divided by the gross income before retirement. For example, assume somebody earns 200,000 Rand per annum before retirement. Further assume they retire and receive 150,000 of the retirement income. This person's income ratio is then 75%, which is 150 divided by the 200,000. The replacement ratio is what members need to maintain their pre-retirement standard of living after retirement. Generally, a person needs less gross income after retiring, primarily due to four factors. One, income taxes go down after retirement. It is because extra deductions are available for those over the age of 65. And taxable income usually decreases at retirement. Two, certain retirement benefits are partially or fully tax-free. It reduces taxable income and therefore the amount of income needed to pay taxes. Three, saving for retirement is no longer needed as that is now paid out to them. And changes in age and work-related expenditure that occur at retirement also influence the amount of income someone needs at retirement. The experience is that members no longer has debts or daily transport costs to pay or school fees or any other things to worry about. Most persons should be able to, at their retirement age, at least own their own property so they don't have a rental payment to make. And mostly the children would be out of school and out of university and looking after themselves, which means they don't have any responsibility as far as dependence is concerned. And therefore, there should be a lesser need for income at retirement. Let's look at the power of compound interest. The best way to ensure adequate retirement income is to start saving early. So when you are told at the age of 20 you need to save for retirement, a lot of young people would say, but why? It's such a long time off. But the whole idea of power of compound interest over time, one cannot lose and keep out of mind. The amount of capital you start with is not nearly as important as getting started early, right? Burton Malkiel in the Random Walk Guide to Investing. Procrastination is the natural assassin of opportunity. Every year you put off investing, making a achieving your ultimate retirement goals just more difficult. For example, if 20 years old Numfundu contributes, let's say 920 Rand monthly to their retirement fund for 35 years and leave the money to earn an average 12% return, the retirement saving will total over 6 million. But waiting 10 years to begin that saving will require now, instead of 920, 1,700 per month to achieve the same objective, whereas waiting for the last 10 years to begin saving will require you now to contribute 25,820 per month. So you can see by starting early, you could start with a 920 monthly amount. Leaving it till very late, the last 10 years, you now need 25,820 Rand a month in order to save up the 6 million Rand. Right, if we look at just a graph here that can display it maybe more graphically, the 920 in 35 years, and how it would have been different if you start only at 30 years, if you only got 20 years left, and when you've got 10 years left, then you need to contribute a 25,820. And if you leave it till 5 years before retirement, you need to save now 72,740 per month, which I don't know whether that is going to be possible for most of us to do. So it's better to start early with a small amount and keep that up over the duration of the period of 35 years. Right, the power of compound interest. To make compounding work for our members, we encourage them to, number one, start early. The younger you start, the more compounding must work in your favor and the better your retirement income. It maximizes your contributions. You remain disciplined and making saving for retirement a priority. Do whatever it takes to maximize your contributions. Be patient and persevere. Do not touch the money. Compounding works only if you allow your investment to grow. The results will seem slow at first, but persevere. Most of the magic of compounding returns come at the very end. Compounding creates a snowball of money. At first, the returns may seem small, but they will become enormous with time. The more money you've got, the more money you'll have. When one retires, the main concern is to protect your lifestyle in retirement and ensure that the available income can be stretched for as long as possible, bearing in mind that no one knows how long you will need this money for. Some of us might live to 65, some of us might live to 70, some of us might reach the age of 100, and then you have a problem if you don't have sufficient funds to carry you to that age. Two risks that member faces are the possibility that you will live too long and run out of money. They call it the longevity risk. The possibility that the income you receive cannot keep pace with your living expenses, which is an inflation risk, which means the value of money decreases. A bread becomes more expensive every year. Petrol becomes more expensive. It is therefore imperative that professional advice is sought. Trustees should assist members by pointing them in the right direction. Most funds will assist their members by arranging for the following: a pre-retirement counseling, member information sessions for those close to retirement, provide default options for those who do not make a choice, and at retirement, the member must make the following two critical decisions: how much of the savings should be taken as cash, how much of your money should you commute into a cash amount, and what type of annuity should be purchased and from where, which company or which organization should you use to purchase your retirement annuity from, or your income portion from. Right now, if we look at the types of annuities, you get a retirement annuity, either a guaranteed annuity, which gives you a level, escalating, guarantee, and then for life, which is a back-to-back or a joint survivorship with profits and enhanced product, or you can buy a living annuity product, which offers you a wide choice of investment vehicles and drawdown schemes. Right, let's have a look at level guaranteed life annuity. It is a traditional type of annuity of a life insurer takes a lump sum payment at the retirement date in exchange for a monthly payment to the life insured. So for your lump sum that you receive from your pension fund, you can now receive a monthly payment. Payments are guaranteed for the life of the pensioner. The advantage of this annuity type is that no matter how long the pensioner lives, the monthly income is guaranteed. The investment and longevity risks are transferred to the insurer. The obvious disadvantages to the member is that the income level does not increase. In technical terms, there is an inflation risk which the member bears because the pension is non-increasing level, but the cost of living continuously increase. The net effect is a reduced purchasing power of a level pension. It is especially a big concern in economies where inflation is high, but not as much of a concern where inflation is modest. Also, there are no benefits for surviving dependents after the death of the pensioner. That is when you buy a guaranteed annuity through a insurance company or a provider. Then you get what we call an escalating guaranteed life annuity. This is like the one that we've just discussed, only different is that it is designed to address the increasing cost of living along the way. Again, the insurer will take a lump sum pension at the retirement date, and in return, it will pay a monthly pension amount. The pension amounts will, however, increase each year. There are several ways in which pensions can increase. The percentage level of increase can be fixed, for example, 5% per annum increase. But what if inflation outstrips this level? It can increase in line with some inflation indexes, such as the Consumer Price Index. You can link it to that, or it can be a function of inflation index, for example, a CPI to a maximum of, let's say, 6% per annum. The escalating annuity protects the pensioner's income against adverse effects of rising prices, but this also comes at a cost. The insurer now picks up the inflation risk and therefore must set aside more money to ensure they can deliver on the inflation promise. So an annuity that guarantees 100% of inflation increase will be more expensive, initially to purchase. And as a result of the fact that there will be future increases and there must be a guarantee, the initial starting pension is therefore much lower. But in time, the pension will increase above the starting fixed pension amounts. Right, if we look at a with-profit life annuity, it is another form of an increasing annuity, however, not quite so straightforward. Under a with-profit arrangement, the annual increases are linked to the underlying investment performances and not an inflation index. When the underlying investment increase in value, one can expect the above inflation pension increases. Still, they stay the same or decrease in value. The annuity increase could lag in inflation. However, over time, with-profit annuity is likely to increase at a rate better than inflation because of a proportion of the underlying assets of the investment portfolio are invested in asset classes that are typically provide a return well ahead of inflation. So yet again, there is a trade-off. You give up the guarantee link with inflation for a possibility of a better long-term returns, but with the added risk that inflation might be higher in some years than the increase in your pension. Then you can also look at a back-to-back guaranteed life annuity. This type of policy has two parts, a life annuity and a life assurance. The member receives a monthly pension, but now part of the monthly pension income goes towards paying for the life insurance premium, which means that the insurer retains part of the monthly pension and pays out a smaller amount each month. The pension is payable for the life of the insured. The difference between this and a traditional annuity is at the time of death. A single life annuity payment ceases on the death of the member. With a back-to-back life annuity, a lump sum death benefit is payable. Of course, there will be a trade-off. The higher the death cover, the higher the monthly cost of cover, and the lower the actual pension payment will be. Then you can also look at an enhanced life annuity. As mentioned before, the cost of an annuity will depend on a host of assumptions, one of them being how long the pensioner is expected to live. The longer the life expectancy, the more payments the insurer will have to make, and therefore the higher the total cost to the insurer. And of course, the reverse is also true. If the person applying for a pension is in poor health, then it is safe to assume that he will not live if his healthy counterparts. So there will be fewer annuity payments, driving down the costs. So a person who can prove they are in poor health can get a higher monthly pension. However, several other features can be added to all the annuities mentioned above, which we will list on the next slides. Right, let's have a look at the joint and survivorship life annuity. The annuity type considered above typically focus on member only. However, some members would want to guarantee an income for their spouse. The joint and survivorship arrangement ensures that the last surviving member of a couple will have a pension for life. The focal feature of these is a reversionary percentage. How much of the original pension payable to Mr. Dlamini would Mrs. Dlamini get after his death? The usual reversionary percentage of 50%, 75%, or 100%, but it would be anything provided it is specific upfront when purchasing the contract. Right, spouse's reversion can be attached to a level, escalating, or inflation-linked annuity type of arrangement. Of course, the spouse reversion will carry a cost. This cost will depend on several factors which are used to determine the expected payment period of the level of payment. Right, gender of the main annuitant. For example, women tend to live longer than men. So adding a female spouse onto the policy means that the insurer, in most likelihood, will have to make a greater number of payments, pushing up the costs of the policy. The age difference between the spouses, the younger the spouse, the longer they will live, again driving up the number of payments and therefore the cost. The reversionary percentage, the higher the reversion, the higher would be the cost. Right, let's look at guaranteed then for a life annuities. Guaranteed period is a common feature of most life annuities. A guaranteed period would need to be specified at the time of retirement. Let's say that the chosen guaranteed period is, say, 10 years. What this means is that the pension will be paid for those 10 years at its full amount per month. Whenever or not the pensioner is alive, it ensures the member benefits meaningful from the lump sum invested in purchasing the pension. If the member lives beyond the guaranteed period, then payments will continue for the rest of the member's life. If, however, the pensioner dies before the guaranteed period is over, the pension will continue to be paid at 100% of its level until the end of that guaranteed period, let's say 10 years. If the pensioner has beneficiaries or dependents, this pension will then be paid to them. The pension will be paid into the estate if there are no dependents. Suppose the pension arrangement had a spouse reversion option as well. In that case, the spouse will receive 100% of the pension until the end of the guaranteed period. Only after the guaranteed period has expired will the pension reduce to the pre-specified reversionary percentage, let's say 50%, or if it was 75%. Right, let's have a look at living annuities. Living annuity is a relatively new type of annuity. It's also known as an investment-linked living annuity. Under this arrangement, the payments are not guaranteed. There is no insurance contract, but rather a pure investment contract. The fund credits from the retirement fund is invested with the insurer in a portfolio chosen by the pensioner. The investment earns a return on the assets be it positive or negative, in line with the performance of the investment vehicle chosen. It means that the pensioner takes on the investment risk. It is the distinguishing factor between guaranteed and a living annuity. Under guaranteed annuity arrangements, the investment risk is passed on to the insurer. The pensioner draws down on the investments by taking a small chunk each month as a pension. The amount of the drawdown allowed is between 2.5% and 17.5% of the value of the capital invested per annum. Risk facing retirees. Right, employment risk and longevity risk, and we'll discuss some more risks. Let's have a look at the employment risk. Many retirees plan to supplement the income by working either part-time or full-time during retirement. Employment prospects among retirees will vary greatly because of demands for different skills and may change with health, family, or economic conditions. Choosing the point at which you would want to retire is integral to retirement planning. Retiring later is an alternative to increasing savings, but there is no certainty that appropriate employment will remain available. Part-time is an alternative to full-time employment, and part-time jobs may be much easier to obtain. The longevity risk. Running out of money before you die is one of the primary concerns of most retirees. Longevity risk is an even longer concern or larger concern today as life expectancy has risen. The life expectancy age at retirement is just an average age, with about half of retirees living past that age and a few living past the age of 100. Planning for enough income to live only to your life expectancy age will be adequate for about only half of people that's retiring. Right, the death of a spouse. Grief over a spouse's death or terminal illness contributes to higher rates of depression and suicide amongst the elderly. Financial vehicles are available to protect the income and the needs of survivors after death of a partner or a spouse, such as life insurance, survivor pensions, a long-term care insurance. Estate planning is also an important aspect of providing for survivors. A change in marital status. Divorce or separation or cohabiting couples can create major financial problems for both parties if there is a change in marital status after retirement. Healthcare and housing risks. Unexpected medical bills. You might contract cancer or something, and you sit with unexpected medical bills. They are a major concern for many retirees. Prescription drugs are a major issue, especially for the chronically ill. Older people usually have greater healthcare needs and may require frequent treatment for various health-related issues. And then, obviously, financial risks, which is your inflation risk. Inflation should be an ongoing concern for anyone living on a fixed income. Even low inflation rates can seriously erode the well-being of retirees who live on for many years. A period of unexpectedly high inflation can be devastating if you live on a fixed amount every month. And then you also have the interest rate risk. The lower interest rate reduce retirement income by lowering growth rates for savings accounts and for assets. And as a result, individuals may need to save more to accumulate adequate retirement funds. Annuity yields less income when long-term interest rates are low at the time of purchase. Low real interest rates will also cause purchasing power to erode more quickly because you are receiving less interest on your investment per month. Lower interest rates can reduce retirement income and can also be partially risky when people depend on drawdowns from savings to finance their retirement. On the other hand, a problem also exists if interest rates rise, causing the market value of bonds to drop if you've got investments in bonds. Increases in interest rate can also negatively impact the stock and the housing markets, thereby affecting the retirees' disposable income. If you are living in a rental facility, and there's an increase in interest rates, then the person you rent from might increase your monthly payments. These can make retirees difficult for retirees, and retirement cannot be affordable due to the effect of your savings income. So higher real interest rates and over and above inflation rates, can be devastating. Right, then there's also the risk of stock market. If you've invested money to grow in stock markets, stock market losses can seriously reduce your retirement savings. Commonly, stocks have substantially outperformed other investments over time, and thus are usually recommended for retirees as part of the balanced asset allocation strategy. However, the rate of return that you earn from your stock portfolio can be significantly lower than the long-term trends. Stock market losses can seriously reduce one's retirement savings if the market value of your portfolio falls. Now, we've seen this in 2020 when the COVID crisis hit. There was huge declines in stock markets, up to 35% of portfolios, which obviously reduced the value of your total savings that you had. The sequence of good and poor stock market returns can also impact your retirement savings amount, regardless of long-term rates or returns. For example, a retiree who experienced poor market returns in the first couple of years in retirement will have a difficult outcome than a retiree who experienced very good market returns in the first couple of years of their retirement. Even though the long-term rates of returns might be similar, early losses can mean that you've lost income during your retirement, which means your capital is reduced largely, and then obviously your return will be from a lower base. Latter losses can have a less negative impact because an individual may have a much shorter period over which the assets need to last. Right, the risk benefits. There are essentially two types of risk benefits, approved and unapproved. An approved risk benefit is a contract between the retirement fund and the insurer. An unapproved benefit is a contract between the employer or the employees as a group and the insurer. Please note that unapproved cover simply means that it is not offered under a tax-approved retirement fund and therefore not covered under the provisions of the Pension Funds Act. The difference between approved and unapproved cover we are going to summarize in the next slide. Right, let's have a look at approved cover. There's a contract with a fund. Unapproved cover, there's a contract with the employer. Right, fund rules. Approved cover is provided under the rules of the funds, and unapproved cover, there is no rules covering the funds. Contributions and premiums of approved cover, tax as a fringe benefit in the member's hands, and then deemed to have been contributed by the employee. The employer contributes and the member contributes are tax deductible by the member, subject to the maximums of 27.5, as we've discussed in earlier sessions, of the greater of the member's remuneration or taxable income, subject to the 350,000 cap per annum. It's tax deductible for the employer. The unapproved cover is taxed at fringe benefits in the employee's hands. It is non-tax deductible for the employee, and it is tax deductible for the employer. Right, as far as taxation of lump sum benefits, approved funds, you can qualify on the scale of 500,000, which is then exempted, and then the rest of the scale up to 1,050,000, where your calculation will be done. It must be noted that any amounts received on previous withdrawal from a retirement fund will be taken into account when applying the above tax table. So if you received, let's say, 100,000 in the past, then only the next 400,000 would be tax-free. With the unapproved cover, which is with the employer, the disability, funeral, and severe illness cover are paid out tax-free to the member directly. Death lump sum benefits is tax-free. unapproved death lump sum benefits are subject to estate duty. Any benefit accruing to a surviving spouse will qualify for Section 4Q deduction, which means that the benefit amount can be deducted before the final estate duty calculation is done. Right, as far as payment of death benefits, the approved fund benefits are paid in terms of Section 37C as deemed equitable by the fund or the Board of Trustees. Unapproved cover, the payment of benefit is not subject to 37C. Benefits are paid to the nominees or the estate. Members nominate who will benefit from the cover, and no one has the power to change that. On the approved side, as far as disability benefits is concerned, permanent disability can be provided under a retirement fund and is treated as a retirement benefit. Under the unapproved cover, temporary disability cover, or PHI, is always regarded as an unapproved benefit. Right, risk benefits. Since 1 March of 2015, the tax treatment of premiums to a temporary disability, PHI policy, and premiums to unapproved group life insurance has been the same, namely, if the terms of the employment contract compels the employer to pay the premiums, these must be taxed in the hands of the employee as a fringe benefit. If the terms of the employment contract compel the employee to pay the premium, these must be taxed in the hands of the employee and must be deducted from the after-tax salary of the employee. There is no tax deductions for employees in respect of premiums to a PHI policy, but as from 1 March 2015, PHI benefits are no longer taxable. Right, so if we look at a comparison here between an approved and an unapproved fund, as far as premiums, tax as part of the fund contribution on approved funds, unapproved funds taxable in the member's hands. Tax deduction of contributions, approved fund, yes, you can as part of the 27.5 and 350 limit. Unapproved fund, no tax deduction. Impact of maximizing retirement savings in the fund. Under the approved fund, yes, you can reduce the amount of contributions which can be allocated to savings. Under the approved fund, no, you don't have the right. Benefits under approved fund, it's taxable on the retirement tax tables. Under the unapproved fund, there is no tax payable. Salary payback available? No, but under unapproved fund, there is a salary payback available, yes. Ability to postpone payments of benefits to retirement. Under the approved fund, no, you don't have that ability to postpone the benefits. Under the unapproved fund, yes, via a cover continuation option. Right, as far as risk benefit premiums, the premiums rates for group life insurance and disability benefits are normally payable monthly in advance to provide cover during that month. If premiums are not paid on time, a grace period of 15 days is usually allowed, after which cover may be discontinued. Death benefits. Benefits are generally payable by retirement funds on the death of a member in service. The benefits payable will be set out in the rules. Death in service benefits in most funds take the form of a lump sum, multiple of annual salary. Still, many funds also pay monthly pension benefits to dependents and other beneficiaries for varying periods of time. Death benefits can also be provided under a separate group life insurance fund. Death benefits are subject to a medical free cover limit and whether or not the member underwent the necessary medical. What is a medical free limit? The medical free limit is the amount of cover granted by an insurer of a fund or the fund itself if self-insured, below which no medical examinations or other evidence of health will be required. So if you've got unhealthy people in a group, then they benefit from this. It is inexpensive to have all fund members be medically examined. Thus, it is not cost effective to examine everyone, particularly those with lower cover. Within any group of people, some are medically sound, and then there are those that are not. And the insurer or fund will only wish to examine those people with high death and disability cover. Medical free limits may sometimes be applied where there is a minimum number of members or a minimum total sum assured. The medical free limit can be amended at any time. However, once a member's cover in terms of the medical free limit available is granted, they cannot take it away. What happens if a member's cover exceeds the medical free limit? The member will be asked for a medical information or to undergo a medical examination to provide evidence of health to obtain cover above the free medical limit. Whilst waiting for this information, the amount of cover will generally be the full cover in terms of the rules, but subject to a maximum amount that the insurer may impose. Let's have a look at the distribution of death benefits. That's Section 37C of the Act. Section 37C of the Act expressly stipulates how death benefits must be dealt with. As a result of the stipulation contained in Section 37C of the Act, trustees cannot deviate from the requirement of the section. The death benefit payable do not form part of the assets in the member's estate and therefore are not dealt with by way of the will, but shall be dealt with in this section. The broad aim of Section 37C is to provide financial relief to members' legal and factual financial dependents in a fair manner between all members' dependents and all nominated beneficiaries. The board must investigate and identify all the legal and factual dependents of a deceased member. Nomination forms go a long way in assisting the board in this regard. The board has 12 months from the member's death to identify and equitably distribute the death benefits. The Act defines dependents and has created 3 categories of dependents. Number 1, a legal dependent. Number 2, a factual dependent. And number 3, a future dependent. A cohabiting partner, for example, could qualify as a factual dependent. The person claiming to be a factual dependent will have to prove he or she was the dependent on the deceased at the time of his death, and the trustees should satisfy themselves regarding the level of dependency. Members may nominate beneficiaries, and these persons will then be considered along with the other qualifying dependents. Right. If we look at dependents, the fund rules will generally define what is meant by dependents. The definition would generally include the member's spouse, their children, biologically or adopted, nominees, and beneficiaries. Trustees need to exercise some judgment in this regard in ensuring that benefits are paid in a form and in shares that reflect the dependent's needs. Now let's have a look at dependent. It's a person in respect of whom the member is not legally liable for maintenance if such person, 1, was, in the opinion of the trustee upon death of the member, in fact dependent on the member for maintenance. 2, is the spouse of the member. Or 3, is a child of the member, including a posthumous child, and an adopted child, and a child out of wedlock. Or it's a person in respect of whom the member would have become legally liable for maintenance had the member not died. Or a person in respect of whom the member is legally liable for maintenance. But the types of marriages which is recognized in terms of Section 37C. In terms of the Pension Funds Act, Sections 37C, a spouse for a lump sum benefit is defined as a person whom is the permanent life partner or spouse or civil union partner of a member following the Marriage Act, the Recognition of Customary Marriage Act, the Civil Union Act, or the tenets of a religion. Right, civil marriage or civil marriages entered in terms of the Marriage Act, they would be marriages in community of property. marriages out of community or property without accrual, and then later on it was marriages out of community of property where the accrual was then added. Then you get your customary marriages. That's marriages is conducted following traditional customs and culture of South Africa's indigenous people as enshrined in the Recognition of Customer Marriages Act or RCMA. Then you get your common law marriages. Cohabitation, also referred to as a common law marriage, living together, or a domestic partnership, is not recognized as a legal relationship by South African law. A custom law partner may receive pension benefits as a factual dependent if he or she qualifies as such under the definition of dependent. A common law partner will, however, not be entitled to their partner's pension interest on termination of their relationship. Right, civil unions. Civil Union Act incorporates same-sex partners and gives the same status to civil marriages as those recognized in terms of the Marriage Act. And then finally, the tenets of a religion. Marriages under other religions are not legally recognized in South Africa, but could involve South African citizens. Right, what is the trustee's discretion? When lump sum benefits are payable, the trustees must use their discretion to decide on the distribution of these benefits. The discretionary powers may vary wide indeed and may empower the trustees to decide on payments to any one or more of very wide category of potential dependents or beneficiaries. Once the discretionary power is exercised, provided that it is exercised in good faith and that the trustee have done everything practical to ascertain the facts and circumstances of potential claimants, the decision, if challenged, is unlikely to be overturned. The court or adjudicator would most likely apply the prudent person test. Right, investigations. Trustees are to conduct thorough investigations before distributing a death benefit. As part of the investigation process, trustees are required to trace and identify all dependents of the deceased member before allocating the death benefit. In tracing process, trustees may not become aware of a dependent of a deceased member and may therefore exclude the dependent or nominee from the distribution process. If the dependent or nominee appears after the trustee have distributed and paid the death benefits, the relevant question that will most certainly be asked is whether the trustee took all reasonable steps to trace before paying out the benefit. There is no duty on the dependents to come forward and prove that they are dependents of the deceased member. The duty to investigate lies with the trustees. Right, so if we look at the allocation of benefits, when determining how to apportion the available benefit between the various dependents and nominated beneficiaries, many factors needs to be taken into account. The following is some of the factors. Number one, the size of the benefit payable. Obviously, the more money that's available, then it's easier to split the money amongst all the dependents. The age of the dependents. I mean, if there's dependents under age, let's say 10 years, 5 years of age, then that money will be kept in trust until a certain age. The relationship with the deceased, the earning potential of dependents, the number of dependents, and then the wishes of the deceased as reflected in a nomination form, if there was such a form. It would be quite in order, for example, especially where the benefits is not large, to decide that the full amount is to be paid to the deceased member's spouse and young minor children in his or her care, while making no payment to major children either in regular employment or able to find employment, or nominated beneficiaries, which are able to look after themselves. And here you sit with a spouse and children that are in need. Disappointed beneficiaries, even if nominated by the deceased, who do not receive a benefit, have no claim against the trustee unless the trustee has not made his decision in good faith or has not applied his mind to this matter. Nomination forms. Before paying out lump sum benefits, trustees should also ascertain whether the deceased member completed a form of nomination of dependents. Such a form cannot bind the trustees, but they would normally try to give effect to the deceased member's wishes. They must not do so whether the member wishes conflict with the provisions of the rules of the fund and with the law. Trustees should carefully exercise any discretionary powers connected to paying the death benefit when the occasion arises. Trustees who have to exercise a discretionary power should be fully aware of the options open to them on the payment of death benefits and the persons or categories of persons covered by the definitions, such as dependents or beneficiaries, etc. Trustees should ensure that inquiries are made by them or on their behalf, which will ascertain enough detail relating to beneficiaries to enable them to exercise their discretionary powers. The payment of death benefits to beneficiary funds. A beneficiary fund is designed to accept and administrate lump sum death benefits allocated to minor dependents by trustees of the deceased fund members. The beneficiary funds are cost effective and tax effective. Payments out of a beneficiary funds, whether capital or income, is tax free. They are governed by the professional trustees and offer institutional investment returns. Beneficiary funds comply with the same regulation and governance standards as any other retirement fund, such as a member's communication policy, investment policy, code of conduct, and risk policy. Right, the payment of death benefits to beneficiary funds continue. Upon the death of a member, the board has three duties. The first duty is to conduct a thorough investigation to identify the circle of potential beneficiaries, for example, dependents and nominees. Second duty is to decide on an equitable distribution of the benefits. And the third duty is to effect an appropriate mode of payment of the benefit. Is it going to be in a lump sum? Is it going to be in a monthly amount, or is it quarterly? How would these benefits be paid out? Beneficiary funds play an important social role as a mode of payment for trustees to consider, particularly amongst blue-collar worker families where guardians may not be sufficiently financially knowledgeable to manage minors' funds on their own, or where minor children are not staying with their biological parents and their interests may not be sufficiently protected. Then they can use beneficiary funds. The board must then note that the payment of the minor child benefits to his or her legal guardian should be made in an ordinary course of events unless there are valid reasons for depriving the guardian of the duty to take charge of his or her minor child's financial needs and affairs. The board must also consider the following relevant factors in making this decision. A, the amount of the benefit. B, the ability of the guardian to administer the amount of money. C, the qualifications or lack thereof of the guardian to administer the amounts of money. D, the time frame until the minor attains the age of majority. E, the nature of the relationship between the guardian and the minor child. And last, the best interest of the minor child. The following reasons are sufficient to deprive the minor or the caregiver of the right to administer death benefits on behalf of minor beneficiaries. If the guardian is insolvent, mentally disabled, and or incapacitated to even manage their own affairs. Right, let's have a look at withdrawal benefits. Withdrawal benefits are payable to members on termination of employment before the age of 55, provided such termination of employment is not due to retrenchment, redundancy, or abolition of office. It could take the form of resignation, dismissal, and termination of contract, or if the member has absconded. Right, so the employer's contributions towards the pension fund interest, the member's contribution plus interest is then transferred from other funds plus interest. That would then form your fund credit that can be allocated. Options on member portion. Cash benefit. Members can withdraw a cash benefit subject to tax. Transfer benefits. Members can transfer their benefits to another registered fund, especially if the member is joining another retirement fund or a preservation fund, or they leave it in the fund and they make their benefits paid up. Right. Benefits at disability. All employees face the risk of being unable to earn an income during their lifetime due to injury or illness, which sometimes might even threaten their employability in the long term. While most employment contracts provide for sick leave of up to 3 months in most cases, most disability cases can prolong beyond the 3 months, and employers may not be able to continue paying a salary for an unproductive employee that they identify. Disability cover provides a solution to the above dilemma. The cover can then either be for a temporary period or a permanent disability before retirement after a specific waiting period. Now, what is a waiting period? A waiting period is when a client must be partially or fully disabled to claim the benefits. Some products will pay retrospectively from day one of the illness, while others will only pay after the expiry of a waiting period. Waiting period on policies is critical as it directly impacts members' cash flow planning on becoming disabled before the onset of the disability benefit payment. So it could be that you sit for three months, without payment due to a waiting period. It's important to synchronize the waiting period in the policy with the company's HR policy. So if the company is willing to pay for 3 months' salary and the waiting period is 3 months, then that will kick in after the company stop payment. Generally, the longer the waiting period selected, the cheaper the premium will be for the income disability product. Right, temporary disability benefits or permanent health insurance. The income protection benefit provide indemnity for loss of income as the client will receive a monthly payment until retirement age. There are also income disability benefits that only provide payment for a limited period, often 12 to 24 months. Income protection benefit protect temporary or permanent disability, whereas the lump sum benefit typically only pay when a client is permanently disabled. The tax treatment of lump sum benefits and income protection benefits may also differ concerning the tax deductibility of premiums and the taxation of these benefits payment depending on whether they are approved or unapproved benefits. Benefits are usually provided as a percentage of the member's salary before disability, commonly 75% of salary. Still, they can be 100% for a limited period, like 2 years, in terms of the Association of Savings and Investments South Africa, CISA, Code of Good Practices on Disability Insurance. The fact is, why it would be 75% is we don't want to put you in the same or better position being disabled than you were before disability, because that would encourage people to cause harm to themselves. The fund rules will specify the definition of disability, which is usually linked to the member's ability to perform in their current occupation. The definitions below are currently used. The definitions is either own occupation. It covers the insured is unable to perform their particular occupation, or own or any reasonable alternative occupation. This definition measures the ability of the insured to perform any occupation for which he or she is reasonably qualified based on his training, his education, or his experience, or any occupation. This definition measures the ability of the client to perform any occupation irrespective of his training, education, or experience. It is the strictest definition, as the client needs to be severely disabled to qualify under the any occupation benefit definition. Most funds would usually cover own occupation, and the definition would then be for a 2-year period of 24 months, and then move to an own or reasonable occupation definition thereafter. Right, B, escalation of disability benefits. Most policies provide for an increase in benefits payable linked to CPI to enable benefits to keep pace with inflation, just like salary increases would whilst the member is working. Escalation is also important should a member die whilst on disability. The definition of salary whilst on disability could be compromised by the 75 provision and further increases sometime for a long period. Rules must be clear and consistent on such issues. Right, premium waiver during disability. Most policies provide for a premium waiver payable by the employer to fund at an extra premium to the insurer to enable continued payments of the fund contribution, group life insurance premiums, and or funeral benefits, so that those benefits are maintained without additional costs to the employer. Usually set at the same level as employer contributions, less disability premiums, as this will be waived during the time of membership is received the benefits. Right. Actively at work clause. Most policies will provide cover for members who were actively at work at the inception of the policy. It is imperative, though, that when there is a change of underwriters, members and on disability identified, and pre-existing condition definitions do not impact benefits of those members in the future. Right, permanent disability benefits continue in an approved fund once the member becomes totally and permanently disabled in terms of the policy and qualifies for the lump sum disability benefit. The lump sum disability insurance benefit, together with the member's fund credit, becomes payable in terms of the rules of the fund. The member's membership in the fund will then be terminated as the member's employment will be terminated due to his disability. When a member is permanently disabled, the client will not be expected to recover and return to his occupation within a foreseeable future. In most instances, the permanent disability benefit lump sum is an acceleration of group life benefit, which is a multiple of the salary, with the cover being gradually reduced as a member approaches retirement age. Typically, the cover will reduce by 20% per annum in the last 5 years. Right. Group funeral benefits is another benefit that can be added to a pension fund scheme. This cover is meant to assist in covering funeral costs. Most schemes provide cover for the entire family up until a child is a major or until after the completion of formal studies. Benefits are usually paid within 24 hours of a claim submission to ensure funds are available for the burial of the person. Right, then also pension funds can provide home loans. The Act allows pension funds to grant a loan to a member or issue a guarantee so that the member may obtain a loan to enable the member to purchase a dwelling or to purchase land or to erect a dwelling on it for occupation by the member or a dependent of the member, provided the land shall be registered in the name of the member or his spouse. To make additions or alterations to or maintain or repair the dwelling which belongs to the member or is his spouse and will be occupied by the member or a dependent of the member. And also grant home loans to erect a dwelling on land that the member or his spouse does not own, but on which land the member or his spouse can exercise a right or privilege in terms of any customary or statutory law to build a dwelling for his occupants or occupation by his dependents. Therefore, the board must put governance mechanisms in place to ensure that the Act's provisions are upheld. This then concludes our session on retirement fund benefits and all the various benefits that can be offered by a retirement fund. We will then move on to our next session, which is Unit 8, Fund Administration and Record Keeping. So that will be the next session that you will attend. Thank you for being in this session. I will then see you in our next session. Thank you very much.